Good afternoon, everyone, and good evening. We got a couple people joining from the East Coast. First of all, thank you all, as always, for joining me. I really enjoy putting these together, and it's been now about a year and a half that we've been doing these every single quarter. So hopefully everyone's logging in because they find some value in it. As always, we're going to be recording these, so we'll send everybody a recorded copy out. You can feel free to share that with anybody you'd like. And I really want to encourage everybody as I go through all this stuff. I know I throw a lot of information at you during these. Please participate in terms of any questions that you might have. There's a Q&A button. There's a toolbar, and it's a little Q&A button. Ask any questions you want. If we need any points of clarification on anything that I'm talking about, please ask me a question. It's a lot more fun, a lot more interesting if I get interaction from everybody. And so again, thank you for hopping in here tonight and joining me. So we'll kind of dig right into it. And actually, somebody's fast right away. We do have a question. Yes. Kayla has welcomed her daughter to the world about a week ago. We sent an email out to everybody. Kayla will be on maternity leave for about 3 months. We are not going to bug her over the next, I'll probably check in with her in about 2 weeks or so, because having been down that road with a couple kids, those first couple weeks are a little bit challenging for sure. But Kayla will be back. She's on maternity leave and welcomed a second beautiful baby girl into the world earlier, at the very tail end of last month. So thank you for asking that. All right, well, let's dig into it. So what do we got going on? That's the one thing. We never have a shortage of things to be talking about during these events. So today, here's what we're going to talk about. We're going to spend some time talking about the banks. Big question everybody's had is what's happening in the banking system. Is it cause for concern? How's the Fed responding? We're gonna start with that. I figure I'm gonna start. I'm gonna finish with the two big topics, but we're gonna start with the banks. Then we're gonna look at some economic data. Also talk about consumer sentiment. We'll talk about the financial markets, stock and bond markets, what's going on there. Going to spend a little bit of time on commodities. And then the other big question I'm saving for last is there's been a lot on the news about the US dollar, de-dollarization, some bilateral trade deals happening around the world in currencies other than the US dollar. We're going to talk about that and potential impacts. And as always, we'll do a Q&A at the end. I really want to encourage anybody, if you have any questions, anything that's on your mind, anything you want to talk about, please ask me. There's no questions are off limits. And if I go too fast on a few of these things, you want me to slow down or dive in deeper. If you disagree with what I'm saying, then obviously I'd like to hear that as well. But let's kind of dig right into it. So first thing, obviously, let's talk about what's happening in the banking system. Well, banking failures are always something that, for good reason, get people nervous. And we had a big one a couple of weeks ago. Silicon Valley Bank failed. There's a second bank as well whose name is escaping me. I should have written it down before I popped on here. We get two pretty big bank failures. And when you heard that news initially, a lot of the pundits were basically saying, well, this is going to take the markets down. It's 2008, 2009 all over again. And that's not really what's happening. And there's a couple reasons for that. Well, we've got Chairman Powell on the right here throwing dollars at it, and he's throwing a lot of dollars at it. We're going to talk about that a little bit. But Silicon Valley Bank, is it a contagion? Is it going to impact the greater financial system? So let's kind of talk about what happened there. So first of all, before I dive into this, bank failures in this country are really at historic lows. We've had two this year. Usually a couple banks go down every single year. Several went down in the 1980s and 1990s. Just in the data that I'm showing you right now, what you see, we had 33 banks that failed in 2008. 2009, 140 banks failed. By 2010, financial crisis was kind of in the rearview mirror. 157 banks failed. Even in 2011, when, again, markets were back kind of where they were trading before at that point, 92 banks failed. So the reason this was such a big deal is that it was a high-profile bank for some reasons that we're going to talk about. But also, it's been pretty quiet. I mean, really, we've had a dozen or so banks that have failed in the last 6-7 years or so. So when another bank went down, it was definitely a reason for people to take note. So here's what happened specifically with Silicon Valley Bank. So basically, it was a $50 billion bank, very big in the technology world. A lot of venture capital firms parked their money, their deposits at Silicon Valley Bank. Companies that they were generally investing with, again, a lot in technology, had their deposits parked at Silicon Valley Bank. One thing that's kind of interesting here is the amount of uninsured deposits. That's deposits above $250,000. You can get excess FDIC, which Raymond James does all that. But that was the majority of what they had on deposit. So that was, the government was not going to be coming in here via FDIC and bailing these depositors out. Most of their deposits were not FDIC insured. What you saw here, pandemic hits, money gets thrown into the system, this gigantic boom in terms of technology. And Silicon Valley SVB's assets go from around 50 billion to almost 200 billion by the beginning of 2022. So they have a lot of cash. And so what were they doing with it? Well, they basically were buying, oops, sorry, here. This is what I was talking about. My screen did not update there. Apologize for that. So this is the balance sheet of Silicon Valley Bank. Obviously rose dramatically in 2020. So what did they do with these assets? Well, they bought treasury securities, which generally speaking is not a problem because the U.S. Treasury is going to pay you back. They control the currencies that they have to. They can print the dollars. It doesn't mean you're going to like the dollars that you get when you get your money back, but you're going to get your money back. This is the first key difference between what's happening now with some of these banks and what happened in 2008, 2009. In 2008, 2009, the toxic asset was mortgage-backed securities. These were securities in many cases that they actually paid out at higher rates than people had anticipated, but some of them just were not going to pay. The Treasury is going to pay your money when this bond matures. But the problem that Silicon Valley Bank had is they unhedged their interest rate risk. And in a year like last year, that really mattered. This is one of my favorite charts. And you've seen this in these quarterly reviews when I've done these in the past. It basically shows gains or losses for the year in a specific asset class and the maximum drawdown, meaning how much did this specific asset class go down at some point during the calendar year. This is the Barclays aggregate bond index. So think very high quality U.S. Corporate bonds dominated by treasuries. We had a year last year that was really unprecedented. If you look at this kind of these bars to the right here, most years, the aggregate bond index might go down 2, 3, 4, 5 or so percent. The worst year we had was back in the 1970s. The maximum drawdown in the ag was about 9%. Even that still managed to eke out a gain for the year. Last year, you had the Barclays aggregate bond index down 17%, closed down 13%. 10-year Treasury, the United States government's been issuing treasuries for a long period of time. The 10-year Treasury bond was down more last year than it was since the 1780s. So pretty much the birth of the nation. They were issuing treasuries back then. The Treasury bond got hammered. So why does that matter to Silicon Valley Bank? Well, let's go back here again. All this depositor money they took in, they basically bought 10-year treasuries when they were yielding about 1.5, 1.7% or so. Well, what happened last year? Treasuries lost value. What else happened? Venture capital kind of dried up. So not a lot of new deposits. What else happened? Business kind of slowed down a little bit. A lot of these emerging tech companies didn't meet their sales number. They burned through cash faster. So what you had is you had Silicon Valley Bank that had to liquidate these treasuries for below market price. They had to do it before these bonds matured. Had they waited until these treasuries matured, they would be made whole, the investors would be made whole, but that's not what happened because of what occurred in the bond market last year. So this caused basically some people to say, hey, wait a second, a lot of Silicon Valley SVB's assets are in unhedged treasuries. It came out they didn't have a risk manager in place for 8 months, which is kind of insane. It also came out that they were not actively hedging their interest rate risk like a lot of the bigger money center banks were. And you had a classic bank run. You had depositors ran for the door and the money was not there to meet those depositors. So what happens then? Federal Reserve comes in and they start with the Bank Term Funding Program. Basically, all it is this. You have the Treasury bond. You know it's going to pay you. Now, what the value of those dollars is because of inflation, that's the big unknown. That's why the market price of these bonds fluctuates. But that bond is going to pay you back. So the Fed basically came in and said, okay, we're going to set up the Bank Term Funding Program. For treasuries and agency securities, we will allow you to use these bonds as collateral for 100% of the par value. So if you got $100 billion worth of treasuries maturing in 10 years, that if you had to sell them today, sell for 90 billion, the Fed says, well, no problem. We're going to loan you 100 billion on that. So they're basically making depositors whole on the fact that, the treasury bonds are going to pay when they come due. So what does this mean in terms of money flows? And this is probably, I think, one of the reasons why the equity markets have been up pretty good in the last couple of weeks, even since this news has happened. Well, the Fed obviously has been trying to pull excess liquidity out of the system. You're going to see another chart next. It's really going to illustrate what we're talking about here. But basically, you had the Fed's balance sheet increasing through 2021. And the beginning of 2022, they said, wait a second, we've got to try to get control of this inflation. We're going to cut our balance sheet back. Let's start pulling money out of the system. Now, when the Fed increases their balance sheet, that's brand new money. So if they go out and buy a bond, they do it with money that never existed before. When they let a bond mature and roll off, that money gets taken out of the system. So for the last year or so, they've been letting these bonds roll off their balance sheet. Well, once the SBB, Silicon Valley Bank thing, excuse me, SVB thing happened, it took about 2 weeks for the Fed to undo almost a year's worth of quantitative tightening. That's a lot of new money in the system. And a lot of times, particularly in the equity markets and the financial markets, it doesn't always look like the overall economy does. It's really a barometer of money flows. Just got a question. Did cell phones, this is a question that just came in. Please ask as many of these as you want. Did cell phones, social media, and the speed of information and the speed at which information is shared, accurate or not, create greater panic and increase the pressure on the bank? I think probably. I mean, I think obviously news is traveling a lot faster right now. I think it was Peter, don't hold me on this, I think it was Peter Thiel, the big venture capital guy that came out and advised all of his companies that had money on deposit there to pull their money out. Things can happen. Things tend to happen extremely quickly. I mean, if you look 90+% of the volume on most of the financial markets right now, it's algorithmic, it's trading models. So it probably accelerates things for sure. No question about that. That's a great question. So that's basically what occurred in terms of the Federal Reserve putting a ton of money back in the system. So how big was this infusion? This is the Fed's balance sheet. So again, they increased their balance sheet. It's money in the system. Fed didn't really do much until the financial crisis in 2008. GFC happens, global financial crisis. They pile a bunch of money into the system. That's over here. And then they kind of, they're adding money. They're taking some money out. They're cruising along. We went through a nice period of time, like 2016, almost 2020, where the Fed on balance was actually sort of letting maturities roll off as they want to. Then what happens? COVID hits. They create more money than anybody could possibly imagine. And wham, we've got Fed balance sheet expands dramatically. And they kept it. They kept expanding their balance sheet for a while. They did it through 2020 into 2021. It was really only 2022 where they started to pull that off. Now, those of us that have been looking at the markets here, particularly last year, you were wondering when the Federal Reserve was going to kind of give up the ship here, because for a long time they've been obviously saying they want to raise rates, but they haven't done it. Up until SBV collapsed, they've basically been doing exactly what they said. Now you have that banking problem. They're throwing a ton of money in the system at levels, back to the GFC. That's a big deal in terms of what's happening. Now, before we talk about some what's occurring in the financial markets, any other questions about what's going on with the banks? What this should do, what this Fed program should be doing is first of all, the large money center banks have been taking in record deposits because money has left some of the regional banks, which I think is most of these regional banks are run extremely well, but they're going through the money center banks that had some other risk management levels in place. We've also gotten questions at RJ in terms of our deposits. We have excess FDIC for some of our funds up to $50 million per account. We also over almost, it's like 96 or 97% of all deposit at Raymond James are FDIC insured, where it was essentially the inverse of that at Silicon Valley Bank. So I'm really confident, obviously, in terms of what we got going on with our firm, but that's what happened with SBV. So if you have any questions about that as we continue, please let me know. So let's talk about the financial markets here. Talked to you about this when I talked about the problem with Silicon Valley Bank. They got hurt because obviously the bond market got hit last year. I went over this. We don't need to hit that one again. But this year, at least, things are a little bit normal. We have had a 4% drawdown so far in the aggregate bond index, but overall bonds are up about 2 to 3% depending on the day. This chart's always much more interesting when you look at equities, stocks. This is the S&P 500. So again, what you're looking at here is intra-year declines versus how the year ended. So to give you an idea, let's look at this giant outlier here on the left side of the chart. This is down 34%, this red number. That was the crash in 1987. Interestingly enough, the S&P was still up 2% that year, but everybody remembers obviously what happened here. But the point is, you recognize there's a lot of variation. Every single year in January, I get a question saying, what do you think is going to happen with the stock market? And my answer is, I think it's going to sell off about 10 to 15%. Not because I have any crystal ball, but because historically, at some point in the year, the market sells off 10 to 15%. Some years are really quiet, like 2021 was. Some years are not so quiet, like 2022 was. But on average, that's what you get. This year's pretty typical. We've had an 8% drawdown already. Gains depending again on what day we're talking about, 6 to 7% so far this year. So pretty quiet, which is a good thing. Now, one of the things too that we always say is, you got to ride out these periods of volatility. And the reason for that is all these assets that we're talking about in terms of these financial assets, they become a lot less risky, riskier the longer you hold them. I got a question here. We were assured that this would not cost anyone. I'm talking about the SVB failure. But who's going to pay? Well, that's an interesting question because, yeah, we're told the federal government is not digging into their pocket directly and infusing cash into the banks. there's a couple ways that the money's is basically being created here. Is the FDIC basically charges insurance premium to member banks. They say they're using that money to make depositors whole. But the other thing is the Federal Reserve is essentially guaranteeing these bonds apart. It does add to throw some money back in the system, which brings it into some questions. Does it put pressure on the dollar in the long term or not? So, when you have inflation like we've had in the last year or so, the answer is who pays? The answer is everybody. Everybody pays because the purchasing power of your dollars go down. And I guess from a policymaker standpoint, the question is, what's going to hurt the least? Is the Fed infusing $300-400 billion into the system going to be better than, in terms of their fight against inflation? Is that going to be better than seeing a lot, Silicon Valley Bank fail, but also it put pressure on the regional banks, many of which didn't deserve it. And I do think they had to do something to secure depositors in a lot of these smaller banks around the country. I mean, just as an aside, I don't really want to live in a country where you got 2 or 3 money center banks. I like local regional banks that are out there working directly in the communities. I think they had to do something to assure the stability of these banks, many of which are actually really good banks. But great question. The answer is who pays? Kind of everybody. Everybody benefits, but also everybody pays. I don't know if that answers you directly. If it doesn't, you can definitely do a follow-up here. Well, in terms of holding these assets for long periods of time, year over year, all this stuff is volatile. This is stocks is the green bar here. Your best year for the S&P 500 is up 47%. Worst year down 39%. Blue bar is bonds. Best year up 43%. Believe it or not, fixed income. Worst year down 13. We actually went through that last year. But all of these assets, as you hold them for longer periods of time, they become less and less risky. And you start going out 10 to even 20 years, all of a sudden stocks become the least risky asset. And that's one of the reasons that you don't want to trade year to year these assets, big directional bets, because you're exposing yourself to the short-term risk. And in many cases, you're giving up that stability and protection you get in the very long term. All right, now this is another chart that I've showed a lot. Now this is U.S. stocks versus developed international stocks. And the question is, has the run of U.S. stocks come to an end or not? Well, it actually might be. So here's what we're looking at here. The purple sections of this chart are periods of time where international stocks outperformed U.S. stocks. And as you see, the leadership kind of changes back and forth, going back about 40, 50 years or so. We've been through a very extended period of time where U.S. assets have outperformed. It's been very frustrating for clients that have held international assets in their portfolios, most of which our clients have had at least some exposure. This looks like it's changing now. You're starting to see now outperformance from international assets versus U.S. assets for the first time really since the financial crisis. It'll be interesting to see if that continues. Now, before I dive into economic indicators that we like to talk about, any other questions? These are two really good ones so far. So let's talk about what's happening economically here. So inflation, this is obviously the big thing in terms of what's cooking with inflation. 73 to basically 83, you had this long period of inflation in the United States. Inflation rates anywhere from 6 to 15%. And then we had this great long period of generally low rates. I mean, people do forget in the 1980s, you were still dealing with 3 to 6% inflation. But really since the financial crisis, since 2008, we've been in these record low 0 to 2% inflation rates. And that came to an abrupt end last year. We hit 9% inflation in June of 2022. So far, that's been peak inflation. But both headline CPI, core CPI, both of those numbers are rolling over. 6% is still more than most of us are comfortable with, but we're off those peak levels that we saw last year. Consumer confidence is a chart I've also used in the past. Ironically enough, when you're feeling the worst is often the best time to be an investor, particularly in U.S. equities. This chart, what you're looking at here, the low points on this chart, the bottom points where it's kind of shooting down, these are periods of extreme pessimism in the United States. The blue number below it is how much S&P 500 went up in the following 12 months after this extreme level of pessimism. And what you find, here on the left-hand side, February 1975, consumers pessimistic. You got inflation, you got a lot of the issues that we're dealing with today, gas prices, all that type of stuff. In the next 12 months, S&P is up 22%. The lowest reading we'd ever seen in terms of consumer confidence was actually in May of 1980 until last year. We beat it last June. But in the ensuing 12 months, again, this market's up 20%. These other kind of peak lows that you see, October 1990, think Gulf War here. March of 2003, the very tail end of the dot-com blow up, 9/11, a lot of things going on. November 2008, and you're in the midst of the financial crisis. Again, super low consumer confidence levels. in every case, the market, the equity market anyway, in 12 months was significantly higher. We hit an all-time low in June. We're going to know next quarter how this plays out with the 12-month number. So far, it's looking pretty good. The markets generally hit their lows around September, October of last year. But again, usually the time to be invested in equities anyway is at these periods of extreme pessimism. Conversely, when you've got these periods of extreme optimism, yeah, sometimes there's some positive returns over the next 12 months, but generally speaking, not to the extent there is when people are feeling bad about the world. So it's kind of an inverse indicator, I guess. Another thing I want to talk about, get a lot of questions in here. We're certainly not real estate experts, but a question that people have is, are we going to have another housing crisis because of what's happening in interest rates? As we all know, a 3% 30-year mortgage in terms of payment is very different than a 6.5% mortgage. You know, the affordability comes into question. I would argue anyway that the real estate market is a lot different than it was in 2008, purely based on a couple of things. So upper left-hand side, this is housing inventories. Really 2004, 5, 6 into 2007, you had excessive amounts of housing inventories. Okay, so there's a lot of supply out there, and there's a lot of speculation also on people owning multiple. You know, you've all heard the stories of people owning several houses and things like that. But you had a lot of supply. So the second that demand dried up, you had this massive overhang of supply. You really don't have that. We're at historically low levels in terms of housing inventories. Now, for clients of ours that own rental properties, rental vacancy rates are also historically at really low levels. So there's some vacancies out there, but not a lot. You don't have this massive overhang of supply that you've had in the past. Single family housing starts, again, they were kind of ramping up from the GFC on up. They're dropping down again below the trend line, below normal. The only thing that's a little bit higher than the trend line would be multifamily housing. So there might be a little bit, there might be something to be said about excess capacity there in terms of that hitting some of those prices. But not to say prices are going to go up or down. I'm certainly not a real estate expert, but the inventories are not there. There's not as much inventory as there was. So if there's some softening in demand, you're not softening that demand up against this glut of supply. That just doesn't exist in the housing market right now. Another thing, consumer savings is a question we've gotten a lot lately. Consumer savings is falling apart, kind of, but not really. And when I say that, it's kind of a wishy-washy answer. But you had savings rates that went up essentially from the financial crisis all the way up. They were rising pretty dramatically. The U.S. consumer, generally speaking, learned their lesson after the GFC, and then they have this astronomical savings that occurred during the COVID era because people were not spending any money; they were stuck at home, and also the federal government was just saying, "Here's a check, and take your money." That's being burned off right now. Savings rates are back to levels that you have not seen since right around the GFC, but the expectation is that the savings rates are going to build again. But in terms of people's ability to carry this debt, so revolving consumer credit as a percentage of your disposable income, meaning how much of your disposable income is going towards paying these debts, we're again at historically low levels. In the O's, it's about 9%. We're still sitting at about 6% or so. So by these measures, is the consumer under some stress? I would argue that there's a swath of people that are going to the grocery store and paying a lot more, that are paying a lot more at the pump, that yes, they are under stress, but these are not necessarily hugely alarming type data points by any means. Now, any questions on that before I talk about commodities? I definitely want to make sure to talk about what's going on in the oil markets and also the metals. I had a couple of great questions so far. If you have any, please ask them. I'd love to try to answer them to the best of my ability. So global commodities, what's happening there? Here's what you're looking at here, and I really want you to focus on this chart on the right-hand side. So these two colored columns here. The first one in the middle is the change in these prices for all these commodities. We're talking energy, grains, industrial metals, all this stuff since December 31st of 2021. So we're talking about a year and a quarter or so. And the next one's changed since the inflation peak that we hit, which was in June 9th of 2022. If you see red, if you see orange, if you see yellow, prices are falling pretty significantly. What you're seeing is particularly energy. That's changing a little bit. We're going to touch on that. But crude oil down about 38% off the peak. Natural gas off 76% off the peak. Gasoline off 22% off the peak. Now, those of us in Arizona, I know I just went to the gas station the other day. I paid like $4.75 a gallon. That's not so much an oil cost price issue. That's really what's being put on the refiners, quite frankly. So the refining capacity is not necessarily there, and they're also getting a lot more mandates put on them, which is leading to higher costs at the pump. But the underlying commodities are going down in price actually pretty significantly. There's a few notable exceptions. One, the grain soybean meal, no idea why. Not going to pretend I do. Sugar, again, no idea why. But you look at the metals I find pretty interesting. This is column right here. You have seen gold's off, but silver's actually up a little bit. And precious metals overall are up since the inflation peak. Now, I'm going to talk about that in a second. We're going to talk about oil first, because I think it's important. There's been some developments in the last couple of days I definitely want to address. So we had an oil high in March of 2022, right after the Russian invasion of Ukraine occurred, of $123 a barrel. As of the end of last month, oil's trading about $75 a barrel. Couple things in place. First, some of the panic has left the oil markets because, quite frankly, Russia's selling all the oil they want to the world markets, so it didn't really destabilize global supply as much as people thought. But the other thing that happened is we hit the Strategic Petroleum Reserve. We hit the SPR pretty hard. They basically were making massive sales out of the U.S. Petroleum reserves all of last year. So we went from about 700 million barrels, 750 million barrels, to maybe about 350 million barrels. It's a lot of supply that got thrown into the oil market. I'm sure that helped quite a bit. Now, the deal that was supposedly made is that when oil got down below 80 bucks a share, at least this is what I'm hearing, we told the Saudis we would replenish the SPR. They haven't done that. They haven't added any oil back in the SPR. So basically what you had last week was kind of pretty big news in the energy markets. You had two big players in oil. There's three major producers in the world. The United States is the largest producer of oil on the entire planet, followed very, very closely by Saudi Arabia and Russia. Well, Saudi Arabia and Russia got together with the rest of OPEC and said, you know what, we are going to cut supply by about 1.5 million barrels a day. So Russia's going to cut about 500,000 barrels. Saudi Arabia is going to cut about 500,000 barrels. All the other players that we know, Iraq, UAE, Kuwait, all cutting production as well. Doing it as we're coming into the summer driving season, doing it as the depletion of the SPR is probably coming to an end. That's going to be interesting to see what happens in the oil markets moving forward. Oil's been really volatile since then. It was up immediately after this was announced, hasn't gone in a straight line, but it's going to be pretty interesting to see what that does moving forward into the summer. Now, the other commodity I want to talk about is gold. So gold, it's always one of these challenging assets. I'm not going to tell you to buy gold, not buy gold, but it's an interesting asset for sure. I've always viewed it as a disaster hedge. It doesn't pay you, it doesn't grow, it doesn't do anything, it just is. It's a store of value. And for the most part, since 1950, central banks around the world were selling off their gold reserves. That changed pretty dramatically in 2010, and central banks have continued to be very large buyers of precious metals. And that's basically kind of put a lot of support under the gold market. And that's one I think that definitely deserves watching. For those of you that are attending, that are clients, you might have noticed that we had a little gold and silver ETF exposure that got added to accounts in January. This is basically why. The metals have always been a tough one to play, because almost like you saw that oil chart a way back, it's down, it's up, it's down, it's up. But there's just something happening with that, where you're seeing central banks around the world are beginning to accumulate gold at pretty aggressive levels. Now, before I go into kind of the hot button topic, even maybe more than the banks, any other questions before I dive into the dollar and the BRICS countries and everything that's going on in that market? Okay. All right. So another question that I've been getting, and that's my goal when I'm doing these things, is I can run through the economic stuff and talk about stocks and bonds, but I want to make sure that I'm addressing the things that you as clients care about. I've been getting this question a lot. So there's a lot of the news right now, and there's a lot of things that people are reading about de-dollarization. So what does that really mean? Let's talk about this. So we benefit from an extreme level by having the reserve currency of the world. So what that means is you can basically go anywhere on the entire planet, you can spend US dollars, and you can basically buy anything that you want. Up until recently, oil, all major commodities, all traded globally with US dollars. This has created incredible demand for US dollars. Now, this cycling out of the dollar has been something that's been occurring kind of for about 20 years or so. In the year 2000, we had about 70% of central bank reserves. So central banks around the world hold their reserve currency. Primarily, they're holding these strong, stable currencies. The bulk of it's US dollars. In the year 2000, about 70% of global reserves were in US dollars. Now it's about 60%. So we've seen this kind of go in already. Got another question here. I presume the US derived oil prices react to global prices rather than reflecting their costs. I'm going to try to answer your question here in terms of oil. Yes, but every country has its kind of hurdle rate where it makes it profitable to extract oil from the ground. So, I'm making up these, I'm pretty close, I think, but I'm just giving you some ballpark numbers. I believe the Saudis can get oil out of the ground for, it could even be single digits. It could be like $8-10 a barrel or something like that. Where I think up in Canada in the tar sands, they need like $50-$60 oil to make it profitable to basically get the tar sands out, refine it out to where you actually get crude. So it's like anything where there's really easy to get oil and there's really expensive to get oil. As oil prices go up, it makes it economically viable to go to the tar sands, to go to some of those areas of the world where it's a little harder to get that stuff out of the ground. So the question again was, I presume that the U.S. derived oil prices react to global prices rather than reflecting their costs. And the answer to that is yes, meaning it doesn't reflect the cost of getting it out of the ground. If it did, you'd be buying Saudi oil for $10 a barrel. You wouldn't be buying it for $80 a barrel. I think that if that doesn't answer your question, definitely feel free to have a follow-up. So anyway, so we have the reserve currency. It's been kind of trending down since then. The other big thing is as well as the global reserve currency, which you can spend anywhere, we also have the global reserve asset, meaning the treasury bond is basically the store of value. So you got thing you can buy stuff around the world with, the dollar. You got what can kind of hold your value, which is the U.S. Treasury. We've benefited enormously as a country by being the issuer of the world's global reserve currency. That cannot be overstated because every country on the planet has to keep dollars on hand so they can conduct trade internationally. If they're sitting on all of these dollars, they might as well earn some interest. So they're going to buy treasuries. So it becomes this kind of virtuous loop where people need dollars, they buy treasuries. The US government has had a lot of freedom to print a lot of debt because there's been a global demand for it. What we've been seeing lately is that is beginning to fracture a little bit. You're seeing countries do deals together that we have not seen for quite some time. Got another question. The BRICS countries are, yes, again, we're going to touch on that. Question is, BRICS countries are Brazil, Russia, India, China, South Africa. Will Japan join soon? And if it does, how will that balance out the status of the U.S. economy? You are reading my mind because we're going to talk about that. It's a great question, though. So anyway, that's the deal. Global store value, treasury, reserve currency, the dollar. So who are the BRICS? So look at this Venn diagram here. Here's what you're looking at. The circle here on the right-hand side, oops, sorry, wrong thing again. There we go. So who are the BRICS? Circle here on the upper right-hand side. This is countries with over 100 million people. So they've got people assets. They got a lot of people. Left-hand side, the greenish kind of circle there. This is countries with over 2 million square kilometers of land. So you got land value here. Bottom is countries with big GDP. GDP is over $600 billion. Where these intersect, these are powerful countries. They got big economies. They got a lot of people. They got a lot of land. Well, 4 of the 5 of these are BRICS countries. You got Brazil, Russia, India, and China, all BRICS countries, and then you've got the United States. So they definitely matter because they've got a lot of different resources. And from an economic standpoint, they definitely matter as well. These numbers are about a year and a half old or so, 2021. But the BRICS countries have 42% of the world's population. They've got 30% of the land area. They've got 26% of the global GDP. They've got 20% of import and export volumes. So they definitely matter. Now, to our attendees' question here about Japan potentially wanting to join the BRICS. So first of all, what are the BRICS? The BRICS was basically an acronym that was developed by Goldman Sachs in the mid-aughts sometime. They threw a name on these developing economies. So let's call them the BRICS. And these are the big ones: Brazil, Russia, India, China, South Africa. They kind of informally now have begun to form this alliance, and now it's even becoming a little bit more formalized on their own. What I find incredibly interesting is these dark purple countries are BRICS countries. These light purple ones are countries that have expressed an interest in joining the BRICS. Our questioner mentioned Japan. I have not heard that, but I will talk about some that I think are pretty interesting. Mexico, hey, one of our biggest trading partners right south of our border, has expressed some interest in joining this alliance. Huge one, Saudi Arabia. Saudi Arabia has expressed some interest in joining this. The petrodollar, meaning the fact that people can go around the world and buy oil with our US dollars really, really matters. And the Saudis have expressed some interest in that. The other one that you've got here, which is really important, this is Turkey. Turkey's a NATO country. So they're part of the NATO alliance. They have expressed some interest in becoming more intertwined economically and potentially then politically with these other powers. That's a very interesting development. You're seeing a kind of a fracture of what some of these traditional alliances have been. Now, I'm going to give this guy a little bit of credit here. So we do on our website, and we have a YouTube channel and Spotify and everything else, we do these regular sort of 3-5 minute updates on a lot of different topics. And this one was done in March 2nd of 2022. It's up on the website. And this was when we were thinking about the idea of freezing all Russian dollar assets and kicking them out of SWIFT. Now, SWIFT is the international system that basically settles banking transactions around the world. At the time, everybody said, "Oh my God, kick them out of SWIFT and let's take all their money." I was really against that, and I said it in this video because if you have, first of all, if you have the global reserve currency, that's a privilege to have that. And basically the reason you have that kind of power is because people feel comfortable holding your money. They don't think it's going to get seized, and they know they can spend it anywhere. You don't want to put barriers up towards that. And SWIFT is vitally important to the global banking system. You don't want to force people to find alternative ways, because they will. Russia already has. China already has. There's a lot of business now that's being transacted outside of SWIFT, and it's growing. I thought it was really stupid to do what we did back in March, but the reality is we did it. And I think what you're seeing now is you're seeing countries, like Indonesia or something like that. I'm just making that one up, but they might get nervous. They might get nervous if they run afoul of the State Department for some reason, and all of a sudden their assets are frozen, or they can't conduct international banking transactions. And I think this has really driven a lot of countries to look at alternatives outside of the Western-dominated banking systems in the U.S. dollar. It's not a popular opinion, but that's what I think, and I think that what's occurring in the world is kind of playing that out. Little plug, shameless plug for ourselves here. So we talk about a lot of this stuff. I don't blast this out to clients because you guys got enough in your inbox and you have enough going on in the world. But usually we got a Spotify channel, YouTube channel. This is just in the last month in terms of different podcasts we've done and questions about Silicon Valley Bank. We talked about that. It's on our website. It's also on YouTube, also on Spotify. If you want more information, let me know. So anyway, we're going back a year now. We kicked Russia out of SWIFT. We freeze their dollar-denominated assets. Well, what happens? Well, Russia and China, that had always done, essentially they're trading with between each other in US dollars. Now they're trading it in Chinese yuan. Okay, and that exploded as soon as we kicked Russia out of SWIFT. Again, I'm not saying it's popular. That's just what's happening. The other thing that's happening now is you've got the Saudis, very interestingly, falling into. We saw this guy. We saw Saudi Crown Prince Mohammed bin Salman with Putin a little bit earlier. Now he's with Chairman Xi in China. They're doing deals together in yuan. Now, Saudi is a country that in the past has firmly been in our orbit. I just think, now I don't believe this is doom and gloom scenario. I don't want to give you that impression. But at the same point, the United States has to, I believe, at the risk of getting political, that we have to recognize countries can trade with and in whatever currency they want. They don't have to choose the US dollar. We have to make it attractive for them to choose the US dollar. But the point is, I wanted to bring this up because I'm getting a ton of questions about it. And I want everyone to make sure that we're looking at this. Now, obviously, this has made headline news since I talked about it about a year or so ago. You've seen it on CNN, you've seen it on Fox, you've seen the shift away from the US dollar. There's a lot of stories about this. Now, I'm not on the doom and gloom camp that says the dollar is going to go away immediately. It's not going to. It potentially could lose some of its prominence. If we continue to be sort of hostile towards trade in our own currency, countries are smart, generally speaking. They're going to find other paths. I don't want to see that happen. But the dollar is not going to go away anytime soon, simply because so much global debt is denominated in US dollars. And it's increased dramatically even since 2008. So the world needs dollars. If they don't need it as much as in the past to trade internationally, they still do. Foreign trade, you might hear about $10 billion deal between LNG deal between France and China and Chinese yuan. $10 billion is nothing in terms of global trade. So what you're seeing in these big headline things, it's really nothing in terms of the size of things. I don't want to see it become something. But even if countries are finding alternatives in terms of global trade, they still need dollars because they got to pay their own debt. And all of these countries, Turkey, Mexico, Argentina, Saudi Arabia, the amount of dollar debt that they've accumulated in the last 9 or 10 years has gone up dramatically. And they're going to need dollars to pay those debts. So with that, I want to open up to general Q&A. We've gone about 40 minutes on this stuff, a little longer than we normally do. We really got some great questions. Nothing is off limits. I wanted to make sure that we covered the big ones, the big topics that I've been getting in what actually has been a relatively quiet year for the financial markets. Stocks are up a little bit, bonds are up a little bit, a little bit of volatility, but nothing like what we saw last year. The questions I'm getting around the banking system, hopefully I addressed that for you tonight. Also getting a lot of questions about the US dollar. Anything else, anything is fair game. I'll give everybody a couple minutes before we wrap it up here, and we have to do the obligatory disclosure that compliance says I've got to do. But yeah, any other questions? please let me know. Oh, got one. All right. Okay, can you talk about inflation? Yeah, I mean, inflation is obviously a big issue. We touched on that a little bit. I'm going to fire back and look at this chart again. So inflation, there we go. So inflation, we touched on this a little bit earlier. You are seeing inflation come in. 6% levels, 7% levels are higher than any of us used to, anybody wants. But you're seeing the price of a lot of goods, the rate of change. Now the thing is, when inflation rates go down, that doesn't mean prices went down. It means the rate of change to the upside went down. So I want to be kind of clear on that. But yeah, so inflation. My hope is I think they're going to put the brakes on a lot of different things with some of these higher rates. It is trending in the right direction. Hopefully that'll continue. Are CDs, another question, are CDs an outmoded way to save money? Absolutely not. They're not at all. In fact, one of the great benefits that we have that we've had in the last year or so is if people came to me a year and a half or so ago and said, hey, I've got a ton of cash. Where can I park it and earn some interest? The answer is nowhere. You aren't going to get anything. Now we've got a lot of options. You can basically, Raymond James pays 4.5%, FDIC insured up to $50 million. Okay, we've captured a lot of assets with that, and again, an incredibly safe way to do it. I'm preferring lately. I know I see a couple names that are in here of people that we've done some transactions for recently. I'm preferring shorter term treasuries because I can get myself 4.5% in short term treasuries, and I know I'm going to get paid. I'm saying short term, so I'm talking maturing in 3 or 6 months or so. So no, CDs definitely not an outmoded way to save money. I think that you've got to, before we start talking about any of these risk assets, you've got to make sure you have cash on hand to meet any kind of emergencies. You want to have, it's okay to have too much cash, and people that have worked with me for a while understand that I'm pretty conservative in that regard, where I want people to have cash in the bank where they're going to be able to sleep well at night. Another question: should you buy oil stocks now? Oil stocks hugely volatile. We added Devon Energy is for some of our, not all of our clients, but is in the portfolio. We also have an ETF that is an energy ETF added into the portfolio. We also have Marathon Petroleum is in many of our portfolios as well. I think that the thing with a lot, personally, if you can handle the volatility, and it depends on everybody's individual situation. Oil stocks are incredibly volatile. They're up and down. They're all over the place. But the capital structure of a lot of these companies right now is very good. And you know what? I don't know that I'm not going to make a prediction on price, but I think oil stocks and energy stocks should be a part of a balanced portfolio. If you have a question one-on-one, call me one-on-one, and we can see if it applies to you. It's kind of very tough to give. It's kind of tough to give a blanket answer to that one. Oh, we got a couple more questions. All right. CD question is because there are mailers coming in with rates going up to 5.15%. Okay, it depends on how far you're going out, and so I would say that, first of all, what's the bank? There's going to be obviously some teasers to it. Our enhanced savings program is daily liquidity, so it's based essentially money market funds at 4.5%. If you're seeing a mailer coming out with 5.15, one of the bank, they've got to be doing something to get above the risk-free rate. The risk-free rate right now is essentially the Fed overnight rate, or the T-bill rate is about 4.5 to 4.7%, depending on the day. So 5.15, you've got to take some risk somewhere to try to, even though it's 20, 30 basis points, to get that excess level return. And it also depends on how long your money locked up. Is it locked up for 2 months, or is it locked up for 5 years? So in terms of the specific bank and situation, shoot me an email. I'd love to take a look at it. Another question: what areas of the world comprise improving international markets versus the U.S. market? Interestingly enough, when you think, this is where kind of financial markets often go slightly different than what you see in the world. So for example, all through the fall we heard Europe is deindustrializing, they're shutting down steel plants, they don't have any energy, that type of thing. That hasn't really been the case. European stocks have actually performed pretty well, and a lot of it's because they've got global footprints. They're doing business in countries outside of Europe as well, and they're big mega companies. And with international stocks, it also becomes a question of what is the US dollar doing. So all things being equal, if you own a basket of international stocks and the dollar is declining in dollar terms, even if that international stock basket doesn't move, you've actually done pretty well and made some money. So that in terms of specific areas, I think there's some, this is just my opinion, Chinese stocks specifically are historically pretty cheap, but I think there's a lot of political risk there that concerns me. So that's that it's a case by case basis, but I think there's a place for international stocks. I see who asked, and we can talk one-on-one about that for sure. Another question: with bond rates now, should we buy a 5 or 10-year bond? That's a little further than I want to go out. I mean, most of the individual bonds that we've been buying, I think there's a lot of, we're still at historically very low rates, 3.5% on the 10-year. It's a lot better than 1%, which we were a few years back, but 5-6% is historically pretty normal. So and the yield curve is inverted, which basically what that means, you can get more interest by buying shorter term bonds and longer term bonds right now. 5 years, I'm comfortable with. 10 years, again, depends on your situation, case by case example. You start to go at 10 years, it makes me a little bit concerned. How about another question? How about your money market right now? Our money market right now is we have a couple of your basic money market. We also there's a JP Morgan liquid asset fund that we use sometimes. There's also Raymond James has an enhanced savings plan that is yielding. They're all yielding about 4.5% right now, which is nice. Another question: any concern about job numbers and number of companies now reducing staff? That was actually something that did I put it in here? Let's see. I think I took it out. Sorry, bear with me here. Yeah, okay. What you're seeing actually is unemployment still at historically low rates. You are seeing wage price pressures, so meaning the amount that the wage increases are basically rolling over as well. So those increases are not happening as quickly now, but you are still seeing kind of historically low labor participation. So we've got really low labor participation. I think that most business owners I'm seeing are still having a hard time finding good employees, but again, it's specific. There's a lot of people now. I think McDonald's just laid off 10,000, Microsoft's laying off, Facebook, Silicon Valley it's a mess that's happening right there. So I think it really depends. It really depends on the actual business and what you're trying to hire for. Another question: what should you do for safe investments now? Well, that's actually, again, I'm kind of reiterating what I said before, but that's a benefit of all the stuff that's occurred in the last year or so. Raymond James can ensure essentially an FDIC insured money market fund up to $50 million US. There hasn't been a time in the last 15 or 20 years where you could get anything like that. I can go out and buy you. I bought some treasuries today for a client maturing in July that are yielding me 4.6%. So there's a lot you can do with your cash right now. Person asked about the 5.15% says, thank you, I was suspicious of the higher rate. It might be legit. I have no idea. I'd be curious who the bank was, but they've got to be doing this. They have to take some risk somewhere if they're going to be offering above the general market rate. So they get 5.15. They got to take some risk somewhere to do it. That could have also been a few weeks ago. Rates are coming back down again. These are all great questions. I'm loving the participation. Any other questions from people? Okay. I'll wrap up with a couple housekeeping things, but I'll stay as long as everybody wants. So housekeeping things, as I mentioned, Kayla, who pretty much everybody on here knows, is out on maternity leave. She will be back hopefully the end of June or the beginning of July. She is doing great. Baby's doing great. Jose's doing great. Everybody's good in that regard. We have Susan may be answering the phone. She's helping us out in Kayla's absence. Andy, as always, is here doing an amazing job. We've got tons of support at the Raymond James home office also. But I got a lot of, when I sent that email out to everybody announcing Kayla's baby, I got tons of well wishes, and I'm saving them. I wouldn't be completely honest with you if I said I told her now. I gave her all these wishes already because I'm going to wait. I'm going to wait like another week because those first 2 weeks, as I know, are pretty difficult. Otherwise, yeah, I hope that you enjoyed this. We're going to be sending out a copy of the recording. This will also go up on our YouTube channel. It will also go up on our website. Feel free to share that with anybody that you might like. If there's anything we can be doing for you that we're not, please let us know. Everybody that I'm seeing here, we've spoken with very recently. But if anything ever is on your mind, again, please reach out to myself directly, member of our team, and always happy to help out. And I will give it another 10 or 15 seconds. These are all great questions. And if there is nothing else, then we will sign off. But I hope I addressed the questions and concerns that you all had. And if there's anything I didn't talk about that you maybe wanted to discuss privately, please reach out to me, and we'll get some time on the calendar to talk about this. So if that's it, you've stayed with me for 50 minutes, and pretty much everyone has. Thank you all very much, and we will talk to you soon.